Okay, welcome back to the deep dive. Today, we're doing exactly what this show is all about. Taking a stack of information, in this case, the full transcript, numbers, commentary from Dollar Tree's recent Q1 fiscal 2025 earnings call, and really diving deep.
That's right. Think of this as, your shortcut, getting beyond just the headlines to what really went down on the call.
Yeah.
Our mission here is to pull out the important stuff, the key financials, the strategies that seem to be working, how they're handling big pressures like tariffs, and what the outlook means for the rest of their year.
Exactly. We'll look at the numbers, hear management's take, and try to figure out what it means for Dollar Tree and, well, retail in general.
It's about cutting through the noise, right? Getting to the core insights.
Absolutely. So let's jump in. The big picture from Q1 performance, how'd they do?
The headline is pretty strong, actually. They exceeded their own outlook across the key metrics.
Oh, okay. Better than expected then.
Yeah, landed a little better than they guided for. Always a good sign.
Definitely. Let's dig into the financials behind that. Standout numbers.
Well, revenue first. Saw a significant increase, up 11.3% compared to last year's Q1.
11.3%. Wow. What drove that?
It was kind of a mix of two engines, really.
Oh.
Solid comparable store sales growth, that was 5.4%. And then also just more stores, right? Square footage was up 7.4%.
Okay, 5.4% comp for the Dollar Tree stores themselves. That's pretty healthy. Was it more people coming in or people spending more? Or both?
That's the good news. It was really a balance. Traffic, so number of transactions, up 2.5%.
Okay.
And the average ticket, how much people spent per visit, that was up 2.8%. Seeing both move up like that is generally a positive sign.
Yeah, definitely healthier than just one or the other. Any particular product areas doing well?
Consumables, the everyday stuff, food, cleaning.
Yeah.
That continued strong, comped up 6.4%.
Right.
But the really interesting part, I think, was discretionary. Things like seasonal items, toys, home stuff. That was up 4.6%.
4.6% on discretionary.
Yeah, and management specifically called that out, said it was the highest discretionary comp they've seen since Q4 of 2022.
Wow. Highest in well over a year.
Yeah.
In this economy, that feels pretty significant.
It does. It suggests people aren't just going there for necessities anymore. They're picking up those extra items too.
So strong sales, balanced traffic and ticket, even discretionary picking up. What did that translate to on the bottom line? Profitability.
Adjusted EPS from continuing operations came in at $1.26, which was actually a penny above the high end of their guidance range.
Beat their own top estimate. Nice.
Yeah. And adjusted operating income was up slightly too, 1.4% to $388 million.
Okay, sales up, comps up, EPS beating guidance. But I think I saw the adjusted operating margin actually dipped a bit, down 80 basis points year over year.
You got it. That's where the story gets a little more nuanced.
Right, 0.8%. Where did that pressure come from if sales were strong?
Well, gross margin actually improved a bit, up 20 basis points.
Oh.
That was thanks to things like lower freight costs, big help, better merchandise margins, they called it improved mark, and lower rent costs relative to sales because sales were higher.
So cost of goods improved, but operating expenses climbed enough to offset that and then some.
Exactly right. The SG&A rates, selling, general, admin costs that increased by a chunkier 100 basis points.
And what was driving that increase?
Management pointed to a few things. Higher depreciation, which makes sense with all the store investments.
Sure.
Wage increases hitting payroll, higher liability claims, and rising utility costs. The usual suspects, kind of.
Got it. Did they mention any offsets?
Yeah, a little bit from lower stock compensation and less temporary labor, especially with many store conversions done, but not enough to counter the increases.
Okay, makes sense. Strong top line, better gross margin, but rising operating costs squeeze the overall operating margin percentage. You mentioned the expanded assortment strategy earlier as a sales driver. Let's unpack that more. Seems key.
Oh, absolutely central. Management directly linked it, especially the multi-price 3.0 format, to driving that traffic, higher ticket, strong comps, and particularly that bump in discretionary sales.
Right. How far along are they with rolling out this 3.0 format?
They knocked out about 500 conversions just in Q1.
Wow, 500 and a quarter?
Yeah, moving fast. And they said they're still on track to get about half the entire store base converted by the end of this calendar year.
Half the chain by year end. And these converted stores are performing better.
Significantly better, yeah. They highlighted that the 3.0 portfolio continues to outperform the older formats.
And this multi-price thing, are we talking big price increases? Is it still Dollar Tree?
That's a good question. They actually clarified. The chain-wide average price for an item is still only around $1 under 35.
Oh, okay.
And get this, 85% of the items in the whole store are still priced under $2.
85% under $2.
Right. So multi-price isn't about ditching the dollar-ish price point. It's about adding more price points, mostly between, say, $1.25 and $5 to offer a wider variety of stuff, but still focused on value. Give them flexibility.
Flexibility, right. And does it get better over time, the performance of these stores?
Seems like it. They reported that the longer a store has been in the multi-price format, the stronger its comps tend to get.
Interesting. Learning curve, maybe.
Could be. Plus, they're taking what works best in the 3.0 stores, the insights, the specific products, and applying those learnings to the older 1.0 and 2.0 stores too. So it's kind of lifting the whole chain.
Smart. That kind of adaptation is crucial. What about the customers themselves? Are they just getting more from existing shoppers or finding new ones?
Definitely finding new ones. They talked about accelerating market share gains in Q1, actually doubled their unit share gain compared to Q4.
Doubled it.
Yeah, and added 2.6 million new customers just in Q1.
2.6 million.
And for existing customers, the ones visiting, like 3 times a month or more, that group grew by 9%. So it's both. New faces and more visits from regulars.
Where are the new ones coming from? Is it the classic trade-down story?
They did mention seeing strong trade-in trends, so yes, pulling from other retailers seems likely.
Okay.
But here's what really jumped out. The growth they saw from higher income households.
Oh, really?
Yeah. They saw sales improve across all income levels, but the biggest jump in traffic came from households earning over $100,000 a year.
Over 6 figures. That's not the traditional dollar store demographic.
Exactly. It really shows the broader appeal they're achieving now. It's not just about necessity for budget-strapped folks anymore. Value, convenience, and that treasure hunt discovery factor.
Everyone loves finding a bargain or something cool.
Right. It seems to resonate across income levels. And that expanded assortment probably makes it a more worthwhile stop for more people.
Makes total sense. Okay, let's shift to the operational side. Inventory and supply chain. Always complex these days. How's their inventory looking?
It was up. Total inventory increased year over year by about 10%, or $247 million. Ended Q1 at $2.7 billion.
Why the increase? Just stocking up.
A few factors they listed. Higher cost of goods, just bringing in more merchandise overall to support sales. The expanded multi-price assortment naturally means carrying more SKUs.
Right. More variety needs more stock.
Yeah. Plus, they have nearly 500 more stores than last year. And importantly, some initial impact from tariffs landing. Goods subject to those higher rates arrived and are now sitting in inventory.
Ah, the tariff impact's starting to show up there. How are they feeling about managing the supply chain overall?
Management sounded pretty confident in their sourcing team, said they're navigating the disruptions. Priority is making sure products are available, especially for big seasons like back to school and the holidays.
Getting ahead of potential issues.
Seems like it. They mentioned bringing freight in earlier for those key events and investing in the stores themselves to handle the product flow better once it arrives.
Makes sense. What's their guiding philosophy on sourcing in this kind of environment?
It's all about finding the lowest landed cost, wherever that may be globally.
Lowest landed cost, not just cheapest factory price.
Right. Includes shipping, tariffs, everything. It means they need to be agile, constantly looking for the best value source to keep delivering value and that discovery element to shoppers. Agility seems to be the key word.
Agility is definitely needed when you talk about tariffs. That was a major focus on the call, wasn't it? How are they tackling that?
Yeah, big topic. They acknowledged it's very fluid, constantly changing, but they emphasized they have contingency plans ready. They talk about having 5 levers they can pull.
5 levers. What are those?
It's things like negotiating harder with suppliers, respecting products, maybe changing materials slightly to lower cost or shift sourcing.
Okay.
Moving production to different countries, dropping items that just don't make financial sense anymore with tariffs. And crucially, using that multi-price flexibility to potentially absorb some costs without hitting margins quite as hard.
Have these levers worked for them before?
They said yes. Pointed back to the first round of 10% tariffs, saying they use these levers to offset about 90% of that impact.
90% offset is pretty good. So what about the latest rounds, including those really high rates we heard about briefly?
They said they're actively deploying the levers again now, and their expectation, assuming current tariff levels hold.
Right. Big assumption.
Very. But if they hold, they anticipate offsetting most, if not all, of the potential earnings hit over the full fiscal year.
Okay, over the full year is doing some heavy lifting there. Does that imply a timing issue, like paying now relief later.
Bingo. They were very upfront about that. There's a near-term disruption, mainly because of timing.
How so?
Some products hit by those higher tariff rates did arrive before they could fully implement the mitigation strategies.
Yeah.
So those higher cost goods have to work through the inventory and the P&L first.
So the cost hits before the fix does.
Exactly, before the full benefit of pulling those levers shows up in the results.
This timing mismatch sounds like it's key to understanding their outlook then. What did they say about the full fiscal year 2025 guidance? Any changes?
They actually reiterated the full year net sales outlook, kept it steady at $18.5 billion to $19.1 billion.
Okay.
And they also reiterated the comparable store sales growth outlook, still targeting 3% to 5% for the year.
So top line expectations unchanged. What about earnings? EPS.
They did slightly update the full year adjusted EPS outlook from continuing ops.
Yeah.
New range is $5.15 to $5.65.
How does that compare to before?
They explained it's essentially the same outlook on a net income basis. The change in the EPS range just reflects the share buybacks they've already done this year. Fewer shares outstanding means slightly higher EPS for the same net income.
Got it. So the underlying full year profit target is basically intact, but this timing issue messes with when that profit shows up during the year.
Precisely. And they specifically called out Q2, the current quarter, as being heavily impacted. They expect Q2 profits to be, quote, meaningfully lower than last year. Potentially adjusted EPS down something like 45% to 50% year over year.
Whoa, down 45 to 50% in Q2. That's a huge dip. What are the specific dollar figures driving that?
It's that timing mismatch again. Costs hitting before the benefits. They gave specifics for the Q2 impact. Roughly $70 million more in cost of goods sold from tariffs than they originally planned for Q2.
$70 million just from tariffs in Q2.
Yeah, including costs absorbed from that temporary window when some rates were like 145%. And on top of that, about $40 million in higher labor and investment costs also hitting Q2, related to rolling out multi-price and implementing those mitigation efforts.
Okay, so $70 million tariff hit plus $40 million investment hit, all landing in Q2.
Right. Those are upfront costs and timing impacts. The expectation, or the plan anyway, is that the benefits and the profit recovery will happen mostly in the second half, Q3 and Q4. As the mitigation levers take hold and the investments start paying off, that's the idea. As those higher cost tariff goods clear out and their strategies gain more traction, they seem confident they can recover it in the back half.
Does the underlying business strength support that idea?
Well, they did say they expect Q2 comp sales growth to be towards the higher end of their full year 3% to 5% range. So they're signaling the customer demand is still there, despite the temporary profit squeeze from these timing issues.
Okay, Q2 pain, H2 gain is the narrative. Sounds like a year with a lot of investment overall. CapEx plans.
Yeah, significant investment. They're expecting capital expenditures for the full year between $1.2 and $1.3 billion.
Billion with a B. What's that going towards?
Includes opening around 400 new Dollar Tree stores.
Yeah.
Plus about $110 million just for reconstructing that distribution center damaged in Oklahoma.
Right, forgot about that.
They also flagged that this year, 2025, should be the peak year for their multi-year investment cycle. They expect CapEx to come down in 2026 and 2027.
Okay, peak investment this year. Shifting gears slightly, any update on the sale of Family Dollar?
Yes. They said that's still on track for an early summer close. Got U.S. regulatory approval.
Good.
Management framed it as positive. Sharpens their focus on just Dollar Tree, strengthens the balance sheet, and should be, quote, highly cash flow accretive.
Any weird accounting impacts from that sale? More timing stuff?
Actually, yes. Another timing nuance. Because Family Dollar is now discontinued operations, Dollar Tree still has to carry the full year of corporate overhead costs associated with it.
Even after they sell it?
For accounting, yeah. But the income they'll get back from the buyer for providing services during the transition, the TSA income, that won't really hit the P&L until after the deal closes, likely Q3, Q4.
So another case of costs hitting the P&L earlier in the year and the offsetting income coming later.
Exactly. Another first half headwind, second half tailwind, purely from timing and accounting.
Seems like timing is the theme of the year. How's their cash position looking with all this going on?
Ended Q1 with $1 billion in cash. Plus, they expect about $800 million in net proceeds from the Family Dollar sale, and maybe $350 million in cash tax benefits from it too.
So, decent cash flow coming in. What are the priorities for using it?
Priorities seem consistent. First, invest in the core business growth. the new stores, the conversions, etc.
Makes sense.
Then return cash to shareholders, mostly via share buybacks. They've already bought back over $500 million worth of stock so far this year.
Okay, active on the buyback front. And lastly, I think they mentioned an investor day.
They did. Planning to host one in New York on October 15th.
What's the goal there?
Basically, to lay out their refreshed long-term strategy and financial outlook now that Dollar Tree will be a standalone business again after selling Family Dollar. A chance to reset the narrative for the next phase.
Got it. Okay, let's try and wrap this up then. We've seen Dollar Tree put up a strong Q1, right? Beat their own outlook.
Yep. Driven largely by that expanded assortment, the multi-price strategy really clicking.
And clearly resonating broadly, pulling in even higher income shoppers.
Right. At the same time, they're juggling these big operational challenges: tariffs, inventory, investments.
And the big story seems to be this near-term versus long-term picture. Full-year outlook basically holding steady.
Yeah, but with significant profit pressure expected right now in Q2, mostly due to that timing lag cost hitting before the fixes fully land.
It really highlights why digging into these calls is so important, doesn't it? You see the complexity beyond the headline numbers, how they're balancing growth plans with real-time external shocks like tariffs.
Absolutely. The specifics they gave, the $70 million tariff impact, the $40 million investment cost in Q2, the 5 levers that provides crucial context. It shows mechanics behind the numbers.
Yeah, it shows the operational levers they're pulling and the tightrope they're walking between strategy and reaction. Okay, so let's transition to our final segment here. As always, this is absolutely not financial advice, just some thinking based on the call details.
The standard disclaimer applies.
Right. So management laid out this very specific narrative. A big Q2 profit hit driven by roughly $110 million in combined tariff and investment costs landing that quarter, followed by a confident prediction of a strong back half recovery as mitigation efforts fully kick in.
That's the plan they presented, yes.
Given the execution risk involved, rolling out multi-price across half the chain, navigating what they admit is a fluid tariff situation, relying on those 5 levers to work perfectly and on schedule, it raises a question. How much conviction can you really have in that precise H1 versus H2 timing playing out exactly as forecast?
It's a fair question. There are a lot of moving parts. Execution, external factors.
Exactly. So if you were, say, skeptical about their ability to perfectly execute that sharp V-shaped recovery in the back half, maybe you think the pain lingers into Q3 or the recovery isn't quite as strong. How might someone think about that? Again, not advice.
Well, purely hypothetically, if you doubted the back half recovery timing or magnitude, you might think the stock could face pressure if Q3 results don't show that immediate strong bounce back they're projecting off the Q2 lows. Perhaps thinking about strategies that play on volatility around Q2 and Q3 earnings, or maybe even a pair's trade against a retailer with a smoother expected earnings path through the year.
Interesting thought. Playing the timing and the execution risk specifically, a complex puzzle for sure.
Definitely something to watch as the next couple of quarters unfold.
Indeed. Lots to digest there. Thank you for joining us for this deep dive into Dollar Tree's quarter.